You'll know when to get out of silver. Certainly would have rather bought it at 40 than 80. But that doesn't mean silver can't go to 150, 200, 250, 300. I think there's a strong case for that. You've got to decide at what point is a profit good enough for you in silver. Even at these prices, if you can afford parts of it, half an ounce, grams of it, the combination of retail and central bank gold stacking to me is an obvious tailwind. But even if it weren't there, I know that gold holds its value better than paper money. So I'm in it for decades. With silver, to your question, how do you know? Will it go to 500? Will it go to 300? Will it go to 250? In inflation-adjusted terms, it hasn't even reached its high yet, in my opinion. So I think silver has, my personal opinion is silver has much higher to go. Will I say 500, 600? That's irrelevant. I realize I'm an executive out of Switzerland selling gold and silver. There's clearly a bias. But Egon, myself, Rick Rule, all of us have high conviction. You know, Andy Scheckman, anyone who's been in this business for decades rather than the Johnny-come-latelys who've jumped in the last 12 months. If you keep waiting for the pullback, none of us can time it, then you're still maybe paying more even then than you would be today. The industrial demand for silver in particular, yes, it's more volatile, but I still think it has a tremendous amount of tailwind. I think the real way to measure the risk in silver isn't to look at the dollar price or the paper money price, whatever it's Australian, Canadian, or American dollar, or euros, or yen, or Swiss francs. It's really looking at the compressions, the spreads, the gold-silver ratios. At what point do you as an individual silver investor want to take your profits? I think there's a heck of a lot more space for silver to run, but it's certainly more volatile than gold. You have to look at it a little more differently. But to say that the manipulation's over, I think is naive. There's still other tricks, margin hikes, and possibly a sell-only market. That's possible. We're all speculating now. But in the long run, precious metals will continue to rise only because the global monetary system, the things we talked about at the beginning, are continuing to deteriorate. And so if you're a trader, you have to be much more careful. If you're a longer term investor, especially in gold, you're not too fazed by these swings. But even if you're a longer term investor in silver, we do know that, in bull markets, silver can shake a lot of people out on the way up.
The risk isn't silver's volatility. It's how investors are trained to measure it. What's quietly being admitted here, as Matthew Piepenburg has warned for years, is that fiat pricing masks real stress inside the system. While ratios and spreads tell the truth, Wall Street avoids. Silver's paper price swings distract from structural signals like gold-silver compressions and margin rule changes that repeatedly force weak hands out. Since 2020, COMEX margin hikes have coincided with sharp silver pullbacks, not fundamentals breaking. This matters for portfolios because volatility isn't random, it's engineered pressure. Matthew Piepenburg argues this is exactly how metals transfer ownership from retail to institutions. And what comes next explains why silver scares investors right before it moves higher.
And that's typical of bull markets, to try and shake as many off on the way up. And few who will ride it all the way to the peak. And many will say you're at peak silver, you should jump into Bitcoin or something like that. Silver's much more volatile. It's kind of like the NASDAQ versus the Dow. Gold versus silver are much more volatile. So you have to be a little more careful on what your exits are for silver. If you're a long-term investor, you still have to be more careful. There is a point. I don't think we're near the top for silver for a number of reasons. For gold, it's very different. Gold's only in a bull market because paper currencies are in an obvious, not just a bear cycle. They're at the end of an order. They're at the end of an era. And that, again, I think is objectively obvious. That's scary. That's actually scary.
Yeah, for sure. Yeah, I'm curious in your perspective on how this can run. So there's multiple, experts, that look at the charts and they say, hey, silver's going to triple digits. Not too long ago, I was in my local coin shop and was talking to my coin dealer.
Silver doesn't top when excitement peaks. It tops when confidence feels safest. The Nasdaq versus Dow analogy matters because speculative assets always overshoot, then violently retrace, something Matthew Piepenburg consistently frames as psychological warfare, not market failure. Gold's bull case is structural, currencies ending an era, while silver rides the trend with leverage, which magnifies both gains and exits. Historically, silver has corrected 30 to 50% even during confirmed bull markets, including 1974 and 2008. The volatility forces discipline on allocation and exit strategy, not price prediction. Matthew Piepenburg emphasizes that confusing volatility with failure is how investors abandon positions at the worst time. Next, the conversation shifts from charts to something far more dangerous: crowd narratives.
We built this friendship, and we talk about the miners and everything, and so it's pretty cool. But he came in, he said, hey, there's this guy going around buying millions of dollars in silver, and he bought out my whole bottom shelf. He went to some of these other coin shops, bought them out and such, and he says that silver is going to $500 in the next few months. And so, and you just mentioned, like, okay, silver can shake some people out, like it can have a volatile swing. I mean, you look at the 2008 to 2011. I mean, silver went from what I forgot what price it crashed down to. I think it was
went
pretty
50
bad.
to 20 to 5 and stayed there for a long time. It was brutal.
And so
brutal.
curious in your perspective on, folks are excited, but are folks getting ahead of themselves and being a little too bullish,
Well, again, I think there's a lot of clickbait out there. There's even that Asian AI guy going around, and 80% of it is accurate, 20% is completely nonsensical numbers. Again, in pricing silver or gold, for that matter, in a fiat currency, I think in comparing that for your exits is more dangerous.
When price targets turn extreme, risk usually hides behind enthusiasm. The $500 silver story mirrors prior cycles, where retail excitement peaked just before brutal drawdowns, something Matthew Piepenburg has flagged repeatedly when narratives outrun liquidity. Between 2008 and 2011, silver's 60% collapse wasn't a failure. It was leverage unwinding and weak hands exiting. Clickbait projections ignore that metals don't move in straight lines, especially when priced in unstable fiat currencies. For investors, this matters because exits based on dollar targets ignore real purchasing power and ratio signals. Matthew Piepenburg stresses that price fantasies distract from discipline, and discipline is what survives volatility. What follows explains why long-term holders think in decades, not headlines.
I'm not a trader anymore, so I'm not helpful to people looking to trade or get in and out. I'm not helpful in saying I think silver's going to 600 to get quick hits, because I don't look at it that way anymore. I look at gold in particular as a monetary metal, silver also, and I look at central bank stacking of gold as a real demand source. I think the retail side is only going to double and triple very soon. I mean, the average gold holder is 0.5% for allocations. It should, well, recently it's getting to 1%. It can get to as high as 4 or 6%. I think that's coming. The combination of retail and central bank gold stacking to me is an obvious tailwind. But even if it weren't there, I know that gold holds its value better than paper money. So I'm in it for decades. With silver, to your question, how do you know? Will it go to 500? Will it go to 300? Will it go to 250? In inflation-adjusted terms, it hasn't even reached its high yet, in my opinion. So I think silver has, my personal opinion is silver has much higher to go. Will I say 500, 600? That's irrelevant.
This isn't a trade thesis. It's a capital preservation argument. Central banks added over 1,000 tons of gold in recent years, a signal Matthew Piepenburg highlights as a vote against paper assets, not a bet on price. Retail allocations remain historically low, under 1%, even as bonds lose real value, creating a symmetry few headlines mention. Silver benefits indirectly as monetary stress leaks into industrial metals, but gold remains the anchor. For portfolios, this reframes metals from speculation to insurance against currency erosion. Matthew Piepenburg consistently notes that inflation-adjusted highs matter more than nominal numbers. Next, the discussion reveals why price targets are the wrong question altogether.
I look at to me at least, I look at the gold-silver ratios. We saw them as low as 15 and 32 in 1980 and 2011. So, you pick your own ratio based on your own profile, your own opinion. For me to say, I see gold is at 600, I think it's a fool's game. It's a mug's game to say that out loud because no one really knows. What I do feel with conviction is that silver has much higher to go, but very few people will pick the top. Very few people I know who trade precious metals do it well. Even the ones I interview with who are traders of the metal, I've watched their signals for years. They've gotten it wrong many times if you're trading. I think if you're holding it for the longer term, gold's a no-brainer. Silver is different. You do have to pick your compression, your ratio that you think you're comfortable with. I know guys who bought silver at 20. They're still in it to win it. They'll probably go much higher, but even they at some point have to look at the volatility of silver and say, this is my sell point. At what ratio do I sell? Not at what dollar price, because that's measuring it with an ice cube. It's measuring like your weight on a broken scale.
The quiet truth here is that price targets fail precisely when volatility matters most. What he's really emphasizing is ratio discipline over headline prices, and that's where most retail investors lose control. The gold-silver ratio hitting 15 in 1980 and roughly 32 in 2011 wasn't about genius timing. It reflected extreme monetary stress cycles, something Matthew Piepenburg has repeatedly highlighted when discussing mean reversion in metals. Silver's upside is compelling, but its historical volatility, often double gold's, means conviction without an exit framework becomes speculation. Investors anchoring to dollar prices ignore purchasing power and relative value, which is why even seasoned traders miss tops. Matthew Piepenburg warns that ratios expose truth markets try to hide. What comes next explains why silver's biggest risk isn't downside. It's emotional mismanagement.
I don't measure it in fiat. How many barrels of oil, how much real estate, etc. can you buy with that silver? That's a very personal decision. But to your key point, what do I price predict? I never price predict metals. I just say they're going to go meaningfully higher. For gold, I still think that's a much longer term trade for gold. Silver will go meaningfully higher, but not without volatility. If you're a big boy or girl and you're in it for the long run, you have to pick your ratio, your gold-silver ratio, and sell at that and be consistent, because you'll never pick the top. If you're a trader, I don't have any advice for you, because I'm not a trader in it. And I don't know many even professional traders who do it well. So I think that's a much riskier game. I'm not trying to avoid the question. Nobody can, with a straight face, give you that answer. But I do think with a straight face, silver will go meaningfully higher, but it can shake a lot of people out on the way. Even gold, in its major gold run from 71 to 80, when it went from 35 to over $800 in that 10-year period, midway through that bull run in 1975 saw a real uh-oh moment in the gold price. That shook a lot of people out.
This is where investors confuse patience with passivity and pay for it. He's drawing a clear line between owning metal and trading noise, something Matthew Piepenburg often stresses when discussing historical bull cycles. The 1971 to 1980 gold run saw a brutal 45% drawdown in 1975, yet prices still finished nearly 23x higher by decade's end. Silver's path will likely be rougher, meaning ratio discipline matters more than conviction alone. Ignoring volatility doesn't make you long-term. It makes you unprepared. Matthew Piepenburg has noted that shakeouts are a feature, not a bug, in real monetary resets. Next, he explains why today's metals rally isn't cyclical, it's systemic.
But again, if you step back and look at gold in particular as a monetary metal in a monetary system that's dying, gold's price moves isn't a speculation trade like NVIDIA or the NASDAQ or an index. Gold's price moves in 2025 and going forward are much more serious and much more terrifying, because it's not about a bull run in a metal. It's about a system falling to its knees right in front of us, a monetary system. This is much different than a typical bull market. And again, it's not the gold camp that's saying this anymore. It's not executives in Switzerland with a hole in the ground that charges money to store it. Egon von Greyer saw this 30 years ago. It's culminating now. And I think it's culminating for all the wrong reasons. The reasons we've predicted, sadly, are coming true, that debt has taken our currency and made it into a beautiful ice cube that's melting right in front of us. Purchasing power is dying. Governments are losing leverage, and they're getting desperate. But the financial system based on paper money is no longer trusted. You don't have to be a fan of the BRICS or China or Russia, but they saw this coming. They're playing chess. We're playing checkers. We're using wordsmithing, politics, BCom, carry on, all the Doge, the US aid, tariffs, whatever, executive motion left or right, Republican or Democrat, I don't care anymore.
This isn't a gold bull market, it's a confidence collapse hiding in plain sight. He's reframing gold not as an asset, but as a warning signal, aligning with what Matthew Piepenburg has called a monetary credibility unwind. Global debt now exceeds $310 trillion, while real yields remain historically distorted, eroding purchasing power silently. When nations diversify reserves away from dollars, it's not politics, it's risk management. Markets still treat gold like a trade, even as trust in fiat systems deteriorates. Matthew Piepenburg has warned this shift feels slow until it suddenly isn't. Next comes the most uncomfortable truth Wall Street avoids admitting.
No one can save a system this far in debt with more debt. You cannot solve a debt crisis with more debt and then pay for that debt with money muskets out of nowhere without destroying the currency. We got away with it for decades. We're hitting that point of reckoning. It's happening slowly but surely. It's death by 1,000 cuts. But like Hemingway also described poverty, it happens slowly then all at once. People don't want to see America, that America could ever do that as the home of the world reserve currency. I say it's Marilyn Monroe, Clark Gable, the Yankees, the Red Sox, the flag on Iwo Jima, all the things that America, iconic America is great for, all the things that I'm proud about America. It isn't the same America anymore. God, doesn't mean the end of it. It's a dramatic change. And that's why gold's going to continue to go north, not in a straight line. It will shake people out. But if you look at gold as a strategic reserve asset, which is what even the BIS is saying, you need to hold that more than dollars. You need to save in gold and spend in fiat. That's what the central banks are doing. That's what the BIS is doing. Even Morgan Stanley, which was no fan of gold for decades, can't deny from their own clients that they're making a 20% allocation to gold instead of bonds because they're a better store of value.
Debt saturation is the quiet line markets pretend doesn't exist until it's crossed. He's pointing to an arithmetic problem, not an ideological one, echoing Matthew Piepenburg's argument that currency debasement is policy, not accident. With US interest expense now exceeding defense spending and the BIS reclassifying gold as a Tier 1 asset, institutions are adapting faster than the public. Morgan Stanley's reported shift toward a 20% gold allocation reflects declining faith in bonds as real stores of value. This isn't anti-America, it's pro-survival. Matthew Piepenburg frames this as preparation, not panic. And next he explains what this means for everyday savers still trapped in cash.
So again, I didn't make this up. The BIS did. The COMEX is telling you this. The BRICS are telling you this. The petrodollar is telling you this. These are not things that we should be shrugging off. These are major signals. Again, not the end of the world, but a massively changing world, and certainly the end of the dollar as the dominant safe store of value. It's my strong opinion. Again, I think the evidence at every level is pretty compelling for that.
This isn't opinion drifting into pessimism. It's institutional signals flashing red that most headlines avoid. When the BIS elevates gold's role, COMEX inventories strain, and BRICS nations bypass the petrodollar, the message is structural, not emotional, as Matthew Piepenburg has emphasized when discussing reserve confidence erosion. The dollar doesn't need to collapse to lose dominance. It only needs credible alternatives and persistent fiscal stress. Safe haven status is about trust, and trust is diluted gradually, not overnight. Investors still positioned as if nothing has changed are assuming stability that history rarely grants. Matthew Piepenburg warns that reserve shifts always look obvious in hindsight. Next, he explains how everyday investors can still respond without extreme moves.
I know it, and I know an ounce of gold for many listeners is just unaffordable. So then get grams of gold. And then there's the poor man's gold silver. I think it's a smart man's silver. So buy some silver, it's more affordable. Even that's becoming less affordable. And silver is volatile, so it is scary. But if you're holding it for many, many years and you have some compression awareness and the ratio awareness, you'll know when to get out of silver. Certainly would have rather bought it at 40 than 80. But that doesn't mean gold can't go to, silver, can't go to 150, 200, 250, 300. I think there's a strong case for that. You've got to decide at what point is a profit good enough for you in silver, and then I would take that profit and use it to buy more gold as a long-term steady preservation asset, which is exactly what the central banks are doing anyway. It's what high net worth investors and family offices are doing. What's sad is a lot of the folks on Main Street who haven't been following gold or thought it was a pet rock or a pawn shop asset or too volatile, even though it outperformed the markets for 25 years, who've been told by the industrial complex, RIA industrial complex, that gold was a pet rock and that Bitcoin would save them. It's not too late to still get a meaningful percentage of gold that you can afford. But I do respect that for many listeners, it seems like they miss the boat.
The real divide here isn't rich versus poor, it's strategic versus reactive behavior. He's outlining a laddered approach that mirrors what Matthew Piepenburg describes as converting volatility into accumulation, not fear. Silver's historical upside during monetary stress is real, but its drawdowns routinely exceed 40%, which is why ratio discipline matters more than price excitement. Central banks recycling gains into gold isn't speculation. It's a balance sheet defense. Main Street was told metals were outdated while gold quietly outperformed equities over multiple decades. Matthew Piepenburg stresses its allocation size, not perfection, that protects purchasing power. Next, he explains why waiting for the perfect pullback often backfires.
But even at these prices, if you can afford parts of it, half an ounce, grams of it, and you're looking to build over 20 years, just keep dollar cost averaging in, because it will save the purchasing power of your wealth better than a checking account with US or Canadian or Australian dollars. That's what I think. That's what a lot of us who are long-term investors in gold think. And I realize I'm an executive out of Switzerland selling gold and silver. There's clearly a bias. Piepenburg selling his book. But Egon, myself, Rick Rule, all of us, I think, have high conviction. You know, Andy Scheckman, anyone who's been in this business for decades, rather than the Johnny-come-latelys who jumped in the last 12 months in the space, and they're all over the internet now. We've always said it's not a trade. It's a preservation asset. You got to be thinking years and years out. And I think years and years out, even if you bought it at the most recent gold high, it'll hold its value better than the dollars you bought it with. And I think that's the key thing to focus on. And there are a lot of guys like Henrik Zeberg that I debated with who have a strong case that you could see a major pullback in gold if the markets mean revert. So they're going to wait for that 30% pullback to buy their gold, or even 40% pullback, which we saw in 75. That's fine if you're trying to time your entry. The problem is a pullback of 30% from what price? From 4,400 or 5,400 or 6,200?
This is where timing risk quietly overtakes price risk. Dollar cost averaging isn't passive. It's an admission that no one, as Matthew Piepenburg notes, consistently buys monetary assets at cycle lows. Gold has experienced multiple 30 to 40% pullbacks historically, yet long-term holders preserve purchasing power far better than cash savers. Waiting for a correction assumes today's price is extreme, without defining the base it's correcting from. Mean reversion works best in earnings-driven assets, not in currency hedges during fiscal expansion. Matthew Piepenburg often reminds investors that regret usually comes from inactivity, not early entry. Next, he explains why patience beats prediction over decades.
If you keep waiting for the pullback, none of us can time it, then you're still maybe paying more even then than you would be today. I don't know. But if I'm holding gold for 15 or 20 years for my grandkids and their kids and for my savings, I just wanted to get as much as I can afford because I'm not trying to trade it. Obviously, I would have rather bought it at 1,800 than 4,400, of course. And I did because I've had a far-sighted view. But if you're coming into the markets now and you don't own an ounce of gold, I respect that it's a tough question because it could be pullback. No one can time it. But again, what would that pullback be? I was in a big debate with Henrik Zeberg in South Africa. At the beginning of the year, gold was at 2,800, and there was talk of a 30% pullback. So nobody bought their gold then because they're waiting for the pullback. At the end of the year, it's at 4,400. If we had a 30% pullback at the end of the year, it'd still be cheaper to have bought in at 2,800. In other words, it's very hard to time. And if you're a trader, good luck. If you're an investor, I know it feels like you're probably buying at a top. But I think 10 years from now, I don't think you'll be so worried about it if you're holding it for the long term. That doesn't mean, and Rick Rule would agree with this too, it doesn't mean that gold in a secular bull market will not have major price moves and going south. It will scare some people out.
This is the math most investors emotionally resist. He's illustrating opportunity cost, not optimism, something Matthew Piepenburg frequently highlights when discussing long-duration assets. A 30% pullback sounds protective, but only if it occurs from a lower base, otherwise waiting becomes expensive indecision. Gold's secular bull markets historically include violent corrections, yet long-term holders still outperform cash by preserving real value. Feeling like you're buying the top is common near regime shifts, not cycle ends. Matthew Piepenburg cautions that conviction without patience is speculation. Next, he explains why gold ownership isn't about bragging rights or timing wins.
If you understand the real reason for owning gold as a preservation asset, which is what Egon von Greyerz has been doing for 30 years, who bought gold, by the way, at a meaningful level at $300, far cheaper than I ever bought it at. I've known Egon for 7 years. We have never sat down and talked about the gold price. He's never gloated about it. He's never cared about it. He's been in this business when I was still trading stocks and bonds when gold was flat for years, and he built his business when gold was flat for years because it didn't matter to him, the daily price move. He just knew over the next 50 years, 60 years, that gold will hold its value better than paper money. That is our strong belief, as gold's a preservation asset. So again,
this perspective exposes why most people misunderstand gold entirely. True preservation investors, as Matthew Piepenburg explains, don't track daily price moves because gold's function isn't performance, it's durability. Aegon's behavior highlights conviction built on decades of currency cycles, not quarterly returns. Gold spending long periods flat is precisely what filters out speculators and rewards disciplined holders. This mindset contrasts sharply with markets obsessed over short-term narratives and monthly CPI prints. Matthew Piepenburg frames gold ownership as financial humility, not bravado.